Thanks very much for that, Awan. Yes, we have with us Neelkanth Mishra, the strategist whom we love listening to and love reading because of the examples he draw about the macros, about the markets with day-to-day life. And Neelkanth, thank you very much talking to us today about your Outlook 2018 on the macro side, on the market side. And I enjoyed reading your recent notes. In fact, my first question to you would be, picking up from that, you maintain that India is a house which is under renovation, so it may remain slightly messy in the medium term, but long term it will be good. And we have seen worries on the macro side re-emerge, however temporary they might be. But the jury is still out about how macros will pan out in 2018. At Credit Suisse, what is your own hypothesis? How long can it remain messy?
Yeah, so I think it can be at least 6 to 8 months more, if not longer, because the clarity on the fiscal side perhaps will start emerging. Itself makes up its mind on how to annualize GST revenues that we've seen so far. So the next year's budget will give us some anchor, and the market will not be as anchorless as it seems to be right now. But once that is done, I think on the fiscal side, you have at least even the RBI or the Monetary Policy Committee will have some clarity on where we are fiscally. On inflation, I think a lot of the disruption that we saw because of weather on vegetable prices, I think some of the housing related pickup that we saw in inflation, I think some of those will start to clear off by March, April. The insolvency cases, I think, will also start to near completion at 180 to 270 days by July, August of next year. Almost 40% of IBC cases would have been sorted out by then, which is a huge clarity for the market because of loss apportionment as to who gets how much loss and what's the eventual loss finally. Now, but the problem is because of this significant uncertainty right now, just like some stock investors, even business investors are also holding back on and to wait for clarity to emerge before they pull the trigger on fresh investments. I think that may take much longer. So therefore, I think a meaningful growth revival is something that is quite some time away.
Mm-hmm. How do you see, some of the indicators around the way credit growth has come back to almost 10%? There are glimpses of good quality earnings in the second quarter gone by. Early to say whether we can extrapolate it or not. Or even the tax collection figures, which continue to be chunky, but slightly on the lower side because of GST 10% lower. What kind of picture do you draw by taking all these indicators?
That's a very important question because the problem right now is that on near-term growth indicators, the quarterly GDP, which anyway is iffy in terms of its utility, in terms of tracking activity, is right now even worse because a meaningful part of quarterly GDP was projected based on sales tax, service tax collection data, which is not there, right? So it's as much, I think, a shot in the dark as anything else. So that's not very useful from an analytical perspective. So therefore, you have to look at parallel indicators. Now, if you look at car sales, two-wheeler sales, tractor sales, they still reflect the top 20-30% of the economy, right? When people think that two-wheelers is rural, and well, yeah, I mean, half the two-wheelers may be sold in rural, but the point is, it's still the top 20-30% of the population there which can afford a two-wheeler. So therefore, we track broad-based consumption metrics like cement, like steel, like oil, and these are numbers which are still showing weakness. And oil was up meaningfully in November, but after a very long lull, and it could be just restocking. Freight volumes remain quite weak, and therefore, my sense power demand growth remains at 4-5% despite all that is happening in UP and other states in terms of increasing power availability. So broadly, the economy is not, the concurrent indicators are not looking good. On the credit growth side, I think we went through a period of a very weak base. We are now starting to see some, bottoming out of inflation and also a low base, and therefore the year-on-year numbers are starting to look slightly better. What has also happened is that the disintermediation that had started off as bond yields had come off and people were migrating to that, maybe at the margin as banks are getting weaker, lower cost funds and the bond yields have gone up, that has stalled a bit. But the aggregate loan growth, in my view, has not really picked up that much.
Let's talk about the rural side of the market or the economy first, because stock market is very well represented by sectors, themes, and stocks which derive bulk of their from tier 2 and rural onwards. There are indications that, or hopes at least, that rural side of the economy is getting ready for higher, wage inflation is coming back, hence more purchasing power, and hence those sectors are likely to do well in India. Are you convinced at that argument, or it looks shaky?
So 46% of India's workforce is in agriculture. If you go to rural areas, 2/3 of the workforce is in agriculture. And agricultural income growth is still quite weak. So if you look at the gross value of output of agriculture, it has 2005 to 14, it grew at 13.5% a year. Since then, it has been growing in single. I still think it will be mid-single digits this year. If you see from 1960 onwards, and perhaps even before that, volume growth in agriculture has been 2.5% a year. The reason income growth was close to 10-11% is that price growth was 7.5%. So if the reason I track CPI is to look at agricultural income growth, because if food inflation aggregate is not very strong, then I think there is a problem. Now, if that large a population is not seeing income growth, then broad-based indicators will not do well. And I want to draw the line at an agri, non-agri rather than rural versus urban, because those boundaries are blurring, right? So there are a large number of, as we have often discussed, nearly half the growth in urban population in the last decade, 2001 to 11, happened because of formation of census towns, right? So these are effectively villages. The government calls them villages. They're actually acting like towns. So as rural infrastructure improves, as electricity availability improves, as road quality, we're still building 50,000 kilometers of rural roads a year. It would have been unthinkable 10 years back. Data availability, phone availability, all of these things are improving. So there is 15-20% of even the rural economy, the more educated, with some more capital, who are actually making better use of this infrastructure to grow their incomes through new businesses. But by and large, broad-based demand growth, I don't think is happening.
How do you see some of the reforms measures taken by the government beyond GST, Pradhan Mantri Sadak Yojana? How is the implementation on ground? Because I do know you conduct a lot of primary research on ground. Also, rural electrification, because clearly almost every speech of Prime Minister does speak about how they are aiming at improving the livelihoods of people in the tier 2, tier 3 city onwards. Because this tie up with the argument that to you, the reading is not very encouraging so far.
Yeah, so I think from a policy perspective, the impetus to rural roads is something that there's a very, very interesting history of how we sort of focused on rural roads too late. At the time of independence, only about 20% of India's villages had all-weather road access. Even by 1980, it was only 27%, 28%. After that, there was some activity for 10, 12 years. By 2000, we are at 54. We are now, I think, well beyond 90%. And there's been a substantial acceleration in the last 3-4 years. Rural electrification, again, the percentage of households electrified is really shot up. Lots of studies of China in the 80s and 90s, which say that the real growth in rural enterprises that happened because of rural electrification. So as people get electricity, they work longer hours, they can automate their work and all of that. There is also, issuance of LPG cylinders. That activity seems to have slowed down a bit. There was very interesting momentum, very exciting momentum early on, as people move away from firewood and goetham and cow dung cakes, and moving to this. This helps them save time, in addition to all the environmental benefits. Direct benefits transfer for fertilizers. This was, you can call it serendipity. In November, when just randomly browsing through some government websites, we came across the astonishing fact that the volumes pushed through on direct benefits transfer and fertilizers were 4 times as high in November as they were in October. So in states like Rajasthan and Maharashtra, almost every district now has DBT ongoing, and 50 to 60% of fertilizer retailers are now reporting volumes. So the first January 2018 launch, I thought this was a 2021 story. It seems to be happening much faster than that. So I think in terms of government policy, I think we are seeing effort being made to make sure that the right people get the benefits. The problem is there are so many people in agriculture, and creating parallel enterprises, creating parallel job opportunities for them, or alternate job opportunities for them, is something that cannot be done in 3-6 months.
Sure. In fact, on that note, Neelkanth, stay with us. We'll take a short break, couple of minutes. We'll be back. We've got to discuss valuations, how to structure your portfolio at current levels, and we'll also discuss what to make of the elections. That's something which Neelkanth also tracks very closely. So we'll be back in this very short break. Don't go anywhere. Welcome back. You're watching a special show on ET Now, Credit Suisse Outlook 2018, and I'm in conversation with Neelkanth Mishra. Neelkanth, let's talk about markets. We've discussed macros, and one gets a sense after listening to you that you continue to remain positive of the markets, but perhaps you don't share the enthusiasm which perhaps large section of the market is actually factoring in for 2018, looking at 26-27% gain on the benchmark levels in 2017.
That's right, and that 27% gain appears very large because December 28 last year was the market bottom, right? So YTD looks a bit exaggerated on a 12-month basis. Well, now we are hitting that phase as well, but the total returns may not be as strong. Secondly, I think most of our work, because of the nature of our business, is focused on the top 150, 200 stocks, right? And so there is a lot of activity outside that. I mean, the market cap is small, but activity levels and people's potential to make returns has been, very different. Is very different outside that. So, as an observer, I find froth emerging there, and I'm a bit worried. But I've been worried for several months. That has not stopped the market. But I do think that there are things there that are starting to look very tricky. But yes, I think on the mainstream 100, 200 stocks, I think that so long as the global markets are okay, we should be good.
So 18 to 20% is the consensus earnings growth for FY19 the street is working on, depending on whom you're listening to. You think there is it's on the higher side and it's likely to be scaled down? What's the level you're watching out for?
Yeah, so I think it'll be 12-13% when it settles down. This is more top than bottom up. Bottom up. So consensus I think is 22%, but bottom up it would be slightly 1 or 2 percentage points lower. But I think we will settle there, because when I look at assumptions, see, a large part of that growth is coming from banks, right? So private banks and PSU banks and so on and so forth. And I think the loan growth and the net interest margin assumptions that are inbuilt into these models need to be revised downwards. I think there is also hope that, and this is a hope that it's always that next year things will be better.